Yes guys, so let's continue with AS2. Next one what we have to see is cost formula. In cost formula, inventory is specifically divided into two types. Inventory which is not interchangeable and one which is interchangeable. What is this non-interchangeable and interchangeable goods? Normally when we talk about, let's take a very simple example. The simplest of example would be jewelry. Because normally when we ask your mom or your dad, particular jewelry, where did I even buy this from? So they'll exactly give you the bill details, the place at which they are purchased, what was the rate per gram when they purchased, at what particular place. They'll give you the entire scenario. Take a spoon from the kitchen and ask them the same thing. When did you buy? Where did you buy? At what price did you buy? They will not be giving you the details. The reason is, normally when you talk about jewelry, it is called as non-interchangeable good. But spoon is an interchangeable good. In a specific sense, when you talk about, also understand, whenever I have an item which is low in volume, high in value, they are called as non-interchangeable goods. These are low in volume and high in value. But interchangeable inventories are high in volume but low in value. Such non-interchangeable goods, we go by specific identification method. But here, when I have interchangeable goods, I have two methods of valuation. One is FIFO and the other one is weighted average. No LIFO and average method, only FIFO and weighted average. What do you mean by specific identification? Specific identification means each unit has a specific measure of cost which you can identify there. Since they are non-interchangeable goods, I exactly know that these particular set of items I have purchased at this particular price. This particular set of items I have purchased from so and so supplier at this particular price on so and so date. This is specific identification. When I can't do that, when I can't go for specific identification, then I'll go for your FIFO or weighted average. LIFO's average cost cannot be used as far as AS2 is concerned. Now come to techniques of measurement of cost. I have two techniques for measurement of cost. The first one is standard cost. Standard cost method is what we have just seen. Cost of raw material, cost of purchases plus cost of conversion plus other cost will give you what is a standard cost method of identifying cost. We can identify cost simple by cost of purchase added by cost of conversion added by other costs to bring the inventory to the current location and condition. Sometimes identifying this way standard cost becomes highly difficult, especially when you have multiple items, having multiple varieties, having multiple costs. The easiest industry and the most applicable industry is the retail segment. In a retail industry, let's take any supermarket. If I call about soaps, I'll have 10 different companies which are manufacturing soap. Each company has again different varieties of soaps. Each one has a different measure. That's only soap segment. Even if each company has 4 soaps, 10 soap companies, totally I have 40 soaps which are there. Now think about how many different items are available in particular retail industry. In one supermarket, how many different products, how many different costs should I identify if I go by standard cost method? Highly difficult. By the time I even value the inventory, it is rapidly changing. It is rapidly changing because one person comes, he'll take 2 items and he'll go up. Again, your inventory has to be valued from the beginning. So in a retail industry, it will be highly difficult for you to value by standard cost method. So here in a retail industry, we go by adjusted selling price method. Adjusted selling price method. Or this is also called as retail method. Since it is used in retail industry, I am giving this name as retail method here. Here I'll say cost is equal to the selling price, estimated selling price which is given there. Normally it is the MRP minus GP percentage. If you reduce the profit from the selling price, obviously we get cost. So in a simpler sense, I am putting it as cost is equal to selling price minus GP percentage. But to apply this formula, it is only the retail industry because their GP margins on every product is always the same. Their GP margins do not vary way too much. This is regarding techniques of measurement of cost. There is cost formula for identifying the value of inventories, that is measurement of cost of each inventory. Both are different, guys, understand. We can close the standard after we discuss about machinery space. Machinery space is an accounting standard interpretation 2 now merged with the standard AS2. Actually it was an interpretation 2. Now it was merged with the accounting standard 2, that is valuation of inventories. Now what do we discuss about this machinery spare? What he says is, as far as the machinery spare is concerned, whether to treat the machinery spare as a AS10 fixed asset or should I treat it as a consumable in AS2, ASI2. Now let's see. Let's say I have some nuts and bolts. Such nuts and bolts are applicable. Let's say it is a 14 mm nut. 14 mm nut can fit into any machinery. Or a 12 mm nut can be fit into any machinery. Such nuts, if I have purchased in a bulk quantity, let's say a 20 or a 30, because I have a regular use of that, how do I treat it? Let's say I have a crane and it has a hook. And such particular hook can be used only to that particular crane. And when will I use? When the hook gets spoiled. Because I don't want idle time, that is the reason why I am putting a machinery spare in my office, so that whenever there is a issue with that, I'll replace the hook and I'll continue the production process. There will not be any idle time or a downtime due to the crane failure. In such cases, how do I treat the machinery spare? Both are two different cases. Both are two different cases. So I'll say that a machinery spare can be capitalized as per AS10, that is fixed asset, only if two conditions should be satisfied. First one, The use of the spare is irregular. You exactly don't know when you will use it. I may use it, I may not use it. The spare is specifically identified to a particular machine and cannot be interchangeably used. And cannot be interchangeably used. If these two conditions are satisfied, then I'll treat that machinery spare as AS10, that is a fixed asset. Whenever I'm capitalizing as per AS10, should I include it in the cost of the fixed asset for which it was purchased? He says no. The spare should be capitalized distinct from the machinery it was purchased for. And should be depreciated over the life of the machinery and not the spare, guys, because the spare cannot have a life. Machinery has a life. So the spare should be depreciated over the life of the spare of the machinery, not the life of the spare. There is no life of the spare because the spare is not even fixed. So without being fixed, how can you estimate the life of a spare? If the machinery is disposed, the machinery itself is gone, then what will you do with the spare now? The spare should be valued at NRV because now it is held for sale. Without that machinery, what will I do with the spare? If these two conditions are not satisfied, the spare should be included under inventories as consumables. They'll come under the head of consumables, which is also forming part of your inventory. Raw materials and consumables is a single head. Nothing so specific as far as the disclosures are concerned for the standard, because you have to disclose raw materials, work in progress and finished goods separately. That is one thing which is given specifically in the disclosure. You have to show the comparison between the cost and the NRV as well. So there's no specific disclosure that is required, but one thing that you have to remember, that always inventory should be presented in the financial statements with a segregation between raw material, work in progress and finished good. You can't just call it as inventory. Oh, you need to identify what is the inventory of raw material, what is the inventory of WIP, what is the inventory of finished good. The total combined is the total inventory. But line-wise segregation is necessary. Obviously. Yes guys, try to solve some problems on this. AS2 valuation of inventories. Question number 1. In a production process, if the normal wastage is 5% of the input, 5000 metric tons of input were put into the process, resulting in a wastage of 300 metric tons. Guys, if it is a 5% wastage on the input of 5000 metric tons, the normal loss is only to the extent of 250 MT. But what was the actual wastage? 300 MT. That means the abnormal loss is 50 metric tons. Normal is 250, abnormal is 50. Cost per metric ton of input is 1000. The entire quantity of the waste is on stock at the end of the year. State with reference to the standard, how will you value the inventory in this case? So let's check how to value the inventory guys in this case. Simple logic of abnormal loss and normal losses. Abnormal loss is clearly given under exclusion from the cost of inventory. But there is nothing regarding normal loss. So normal loss cannot be reduced from the value of inventory. So let's check. Maintain two columns. One is a quantity and other one is amount. Input. That is nothing but the raw material. You have input 5000 metric tons of raw material. And the total amount, each MT, cost per MT is 1000. So you will get 50 lakhs as the amount. However, you have a normal loss on this. What is a normal loss? 5% is the normal loss. If 5% is normally lost, then 250 MT is lost. That means I'll normally be left out with 4750 MT having a cost of 50 lakh rupees. From this I can identify what is the cost per metric ton. What is the cost per metric ton? Cost per metric ton is 50 lakhs divided by 4750. $1052.62 is the cost per metric ton. So what is the value of inventory? I'm left out with only 4700 metric tons because there is a 300 MT of loss. There was a 300 MT of loss. There is a 50 MT of abnormal loss. Abnormal loss is 50 metric tons. You know cost per empty, you multiply with this value of inventory left out, you'll get the answer. This one will be 47 lakhs change. It is 49,47,360 is the value of the inventory left out, and the abnormal loss should be 50,250, I guess. $52,631 is the value of abnormal loss. Actually, it should be 640, I guess, because you have to round it off to 50 lakhs. The total value of inventory and the abnormal loss should be 50 lakhs. You can round it off to 640. There's some difference because of the points that we have taken. Yes guys, go for the next one. Very small part of the AS2 is touching again. X Limited has 5,000 ACs in stock as on 31st March 2015. Cost of each AC was 10,000 rupees. There was a firm commitment of sale, binding sale agreement of 1,000 ACs of a company valued at 15,000 rupees per AC. Whenever there's a binding sale agreement and when you see that the selling price, estimated selling price is greater than cost, 15,000 is the selling price but my cost is only 10,000. So whenever it is exceeding, there is a future gain which I can't recognize as per conservatism principle. So I have to value the closing stock at cost. For how many items? For 1,000 units. But however, the general price of the AC towards the year end is only 9,500 rupees per AC. Cost is 10,000, NRV is 9,500, so we have to value it at 9,500. How many units are there in the closing stock? 5,000 units. What is the binding sale agreement? 1,000 ACs. That means balance 4,000 I can't value it at cost now. Balance 4,000 I have to take lower of cost or NRV. So, valuation of stock. Units and amount. First one, stock under binding sale agreement. Thousand units. my remaining stock 4,000 units. Total stock is 5,000 units. These 1,000 items, my selling price under binding sale agreement is 15,000 while my cost is only 10,000. I have to take it at cost because it is estimated to be sold above cost. So take a value of 10,000 rupees per AC into 1,000. I think it is 1 crore, I guess. Yeah. Should be 1 crore. Because it is 10,000 rupees per AC. But the remaining stock, I can't value at cost because the NRV is 9,500. This should be valued at 9,500 per AC. So 9,500 per AC into 4,000 ACs. I guess this is 3,80,000. Sorry, 3 crore 80 lakhs. Total value of closing stock is 4 crore 80 lakhs. Small point of the binding sale agreement he touched here. Very, very tiny part of the standard. Turn to question number 3. Opening stock of finished goods is 1,000 units at 25,000. So per unit cost is basically 25 rupees. My opening stock of raw material is 1,100 units valued at 11,000. Raw material cost is 10 rupees. Purchases again at 10 rupees, 1 lakh. Labor charges are 76,500. In addition is putting up with fixed overheads of 75,000 and sales are 2,80,000. Closing stock. Raw material is 900 units and finished goods is 1,200 units. So he's asking you to calculate what is the amount of finished goods. So let's check. Expected production for the year is 15,000 kgs and of the finished product. But due to fall in the market and the sale price of the goods was only 20 rupees per kg, while the replacement of stock of raw material is 9.5 rupees per kg. So he's asking you to value the finished good, guys. What is the value of the closing stock, he asked. So let's check the value of the closing stock. How many units are being produced? Just check that first. Number of units produced. Opening stock of finished goods. This is opening stock plus purchases minus closing stock. Thousand units of finished good existing. One second, guys. We need to check for raw material. Raw materials is used in the production. So 1,100 opening stock of raw material. Raw material purchased was 10,000 units and raw material left out is 900 units. So what has been utilized for the production is 10,200. What has been utilized for the production is 10,200. So let's check now. Identify your cost per unit. My cost per unit, I'll start with the opening stock. Quantity and amount. Opening stock 1,100 units, each one costing 11,000. Then I have purchases. How much? 10,000 units purchased at a cost of 1 lakh. Reduce it with the amount of closing stock. 900 units purchased at 10 rupees per unit, so it should be 9,000. So my cost of purchases of the production is 10,200 units, having a cost of 1,02,000. This is cost of materials. Now we have to add direct labor. $76,500 direct labor. This is the direct cost so far. 1,78,500 is the direct cost. Fixed overheads I can't add easily because fixed overheads should be absorbed on the basis of production, normal production. So the total cost is 1,78,000. This is called as prime cost per unit. Identify the prime cost per unit. 1,78,500 divided by 1,02,000, 10,200 units. Cost per unit is 1,78,500 total prime cost or variable cost divided by 10,200, 17.5. This is variable cost. Variable cost on the basis of actual production. But fixed cost, that is nothing but the fixed overheads, should be absorbed on the basis of actual production. Check. What is the normal production? Normal production is 15,000 units expected. Your fixed overheads are 75,000. So 75,000 absorbed over 15,000 units. Normal production 5 rupees. So my total cost of production is estimated to be 22.5 per unit. This is per unit closing stock value. But what did he say? He's saying that the sale price of the finished good per kg is only 20. Cost is 22.4 to 22.5. But your amount of finished good, the estimated selling price is only 20. So lower of cost or NRV, I'll start valuing it at 20 rupees, not at 22.5. So my value of closing stock quantity, rate per unit and amount. Finished goods, opening was also about 20. Opening was also more than 20. Check opening stock of finished good. 1,000 units at 25,000, that means 25 rupees per metric ton. So that is also more than 20. So this should be valued at NRV. Since it is lower than cost, I'll value it at NRV. Total finished goods at 1,200, valued at 20 rupees. But my raw material, check your cost at NRV. Raw material cost was 10. Raw material cost was 10, but the replacement cost is only 9.5. This is 24,000. I think this is 8550. Total is 32,550 being the value of closing stock. Let's check the next one. Raw material inventory of a company includes certain materials purchased at 100 rupees per kg. The price of the material is on a decline and the replacement cost of the inventory at the year end is 75 rupees per kg. It is possible to convert the material into finished product at a conversion cost of 125. Decide whether to make the product or not to make the product if the selling price is 175 and 225. Find out the value of inventory in each case. So what does he say, guys? He's saying that the raw material is purchased at 100 rupees per kg and the price of the material is at a decline. The replacement cost is only 75. So if you are valuing it the raw material and I have to value it at 75 rupees, incurring a loss of 25 rupees per kg. But it is saying that he can possibly convert it into finished good at a conversion cost of 125. So 100 rupees already I incurred. If I incur 125 rupees more, then definitely I can sell the finished good at what price is? If the selling price is 175, he is saying at the selling price of 175, or he is saying 225. Guys, if I actually manufacture it, 100 rupees of cost which I have already incurred plus cost to be incurred 125, my total cost of production will be 225. If the selling price of the unit is only 175, that means I will be incurring a loss of 50 rupees per unit, which is of no use. So because if I leave it at the raw material stage, my loss is only 25 rupees per metric ton. But check the other case. When the selling price is 225, if the selling price was 225, my cost is also 225, at least I will be covering up for the loss in the decline of raw material. So if it is the first case, I will continue to, I will not produce a finished good. But if it is the second case, when the selling price is 225, I will definitely continue to produce the finished goods. So let's check. Case 1. When the selling price of finished good is equal to 175. In this case, first, what is the cost of raw material? 100. My conversion cost for raw material to become the finished good, I'll have to incur 125 more. So my total estimated cost of finished good is 225. Estimated selling price of finished good, if it is 175, there is a future loss is 50. A future loss of 50. Existing loss for a decline in value of raw material. I purchased it at 100. What is the market price? 75. My loss is 25. Which loss is lower? Future loss is higher than the actual loss. So why do I manufacture? Better not to continue to manufacture finished goods. However, if it is case 2, if the selling price of finished good is equal to 225, in such cases the future loss will be 0 because my estimated cost of completion is completion. So my future loss on sale of finished good will be 0 Hence, manufacture is suggested. Because if I do not manufacture, I'll have a loss of 25 rupees in the raw material. So at least if I manufacture, I'll be covering up that 25 rupees of a loss. Check the next one, problem number 5. Can PT Limited, a wire netting company, while valuing the finished stock at the year end, include interest on bank OD as an element of cost? Guys, interest is a specific exclusion from the cost of inventory, for the reason that the overdraft has been specifically taken for the purpose of financing the current assets like inventory and meeting day-to-day expenses. Clear exclusion, guys, from the standard. So please do not include that. We don't have to write any answer for that, because while discussing the standard, we clearly have written it under exclusions. Next one. Go for the 6th one. USA purchased raw material for 400 rupees per kg. Company does not sell raw material, but it uses it in the cost of production of finished goods, and the finished goods in which raw material are expected to be sold below cost. Very clearly is saying the finished goods in which raw material is used are expected to be sold below cost. That means after manufacture of finished good, you will be incurring a loss. Your cost of production is greater than the estimated selling price. Next, at the end of the accounting year, the company is having 10,000 kgs of raw material in stock, and as the company never sells the raw material, it does not know the selling price of the raw material, and hence cannot calculate the realizable value of raw material for valuation of inventories at the end of the year. However, the replacement cost of the raw material is 300 rupees per kg. What is the value of raw material? How do you value the raw material? Just read through the question again. Very clearly is talking about few things. Normally, what is the valuation in this case? He is saying that the finished good in which the raw material is supposed to be used will be sold below cost. That means compulsory there is an amount of future loss. So whenever I am trying to value the inventory in the cases where the selling price is less than the cost of production, if the estimated selling price of finished goods is less than the estimated cost of production, in this case, inventory should be valued at cost minus estimated future loss. This is what we have read. Whenever the finished goods is expected to be sold less than the cost, then I'll value the inventory at cost minus estimated future loss. But read through the question. Is there anything even regarding the estimated future loss? At the end of the accounting year, the company had 10,000 kgs, and as the company never sells the raw material, it does not know the selling price. Hence, it could not calculate the realizable value of the raw material for valuation. However, he is saying that the replacement cost is 300 rupees per kg, while he has purchased it at a cost of 400 rupees per kg. This value I don't know. But I know one thing, that inventory cannot be valued at cost. I know one thing for sure, that inventory cannot be valued at cost because there is an estimated future loss which should be written off. So inventory should be definitely less than cost. So the inventory of raw material should be always valued less than cost. Now, what is the most reliable measure that you can take from this? 300 rupees per kg. So my value of raw material is equal to, let's take it at realizable replacement cost. How many kgs are left out? 10,000 kgs. The most reliable figure, lower than cost, I'll take 300 rupees per kg. That is 30 lakhs. But well, if I know the estimated future loss, I would have deducted it from cost. Since this information is not there, I am valuing it lower than cost. So lower than 400, the reliable measure which is given in the question is 300. Take that value. Check the problem number 7. Night Limited sells beer to customers. Some customers consume the beer in the bar run by Night Limited. While leaving the bar, the consumers leave empty bottles in the bar and the company takes possession of these empty bottles. If the company has laid down a detailed internal record procedure for accounting these empty bottles, which are sold by the company by calling tenders, keeping this in view, state whether the stock of empty bottle is an asset or not. Now first thing that you need to know is what is the asset recognition criteria. There are 3 recognition criteria for an asset. 3 very, very important recognition criteria to call it as any asset. The asset might be fixed asset, it might be intangible asset, it might be inventory. You call any particular asset. I'll have 3 particular things or 3 recognition criteria which should always meet. Recognition criteria of asset, any asset. First one, future economic benefits arise from either their use or sale. You can do anything. Because normally fixed assets and intangible asset, you get future economic benefits on use. But inventory, you get future economic benefits on sale. Second one, within the control of enterprise. Such a control can either be physical control, like your mobile phone. I normally put it in my pocket. That is a physical control that you are exercising over it. A vehicle, the key is with you. That's a physical access control. So either the control can be physical or sometimes can be rooting out of law. Because legally also you might get a control over it. So legal control is also there. So whatever it is, it should be within the control. And the cost can be reliably measured. If not possible, value the asset at nominal value. Let's say I got an asset from the government free of cost. He has given me this asset saying that take, let's say it's a Dwakra organization which is basically for the upliftment of women and the children. So they have given a small sewing machine to, the society and to one of the lady in the society free of cost. In such cases, future economic benefits arise. Yeah. Once I'm using it, definitely for the manufacture of something, there is a future economic benefit arising from the sewing machine. Is it within the control? Yeah, it is given to me. Definitely I'll be accessing some physical control over it. Can the cost be reliably measured? I did not incur anything. I haven't incurred any cost. Is there any cost which I incurred? Nothing. It is given to me free of cost. In such situations, wherever it cannot be reliably measured, you always have to value at nominal value. Got it? Now, apply it here. Come on. So what is he saying? There's basically a bar which is run by Night Limited. Consumers come, they consume the beer, they leave the bottles on the table and they go out. Now when I sold the beer, I sold it along with the container. That is the glass. Yes, along with the bottle I have sold. It is not possible for me to sell beer without the bottle. So what happened? When I sold it, when I have collected a price for it, basically the bottle now belongs to the consumer. If he is, in a position that he can take it, he can put it in his bag and take it along with him. Well, that is not the normal scenario. They normally leave the empty bottles on the table and the company and this Night Limited is taking care of all the bottles, putting them aside. Detailed internal record procedure is there and then he is selling it by calling tenders. Sale will give you cash. First condition satisfied. Economic benefits arising on sale. Second one, he only said internal record procedure is there. That emphasizes on control. Unfortunate thing is I don't have cost. Because that is not my asset. That should be actually consumer's asset. But I'm getting it free of cost. Instead of he taking it, I am taking possession of these bottles, so I get free of cost. Now this free of cost asset, whatever I've taken now, since the value cannot be ascertained, I will take it at nominal value. That is the question. Decide whether the stock of the bottle is an asset. Yes. The first question answer is stock of empty bottles is an asset since it satisfies aforesaid conditions. What else? If so, whether the stock of bottles existing on the balance sheet date is considered to be inventory and valued as per AS2 or should it be considered as a scrap? Inventory definition. What did it say? First part, inventory is an asset held for sale in the ordinary course of business. It is my ordinary business. It is my ordinary business because basically this bottle is arising from the normal sale of beer itself. So it is an ordinary business done regularly. Since it is ordinary business, my stock of bottles is considered to be inventory as per AS2 and valued at a nominal price and a nominal amount since the cost cannot be reliably measured. If I value it at NRV, what happens? The closing stock value increases because I am not selling it today. I'll be selling it in future, but I'm recording it at NRV. Automatically closing stock increases. Closing stock increases, GP increases, GP increases, net profit increases. Unnecessary increase, unless and until the sale is there, I cannot recognize revenue. So I'll still be showing it at nominal value. Quite typical question and practical oriented question, guys. Regularly has been asked in the exams.